A new massive risk to the crypto industry has just come to light, and there could be a huge dump coming to the market soon. This is your Altcoin Buzz news. Hey, what's up everyone? My name is Cody Buffington. Make sure to like, subscribe, and turn on notifications as soon as we drop our latest content. Follow us on Twitter at AltcoinBuzzIO, and as always, this is not financial advice, and we wish you the best of luck in your crypto ventures. The United States Securities and Exchange Commission, or the SEC, on January 12th has charged cryptocurrency lending firm Genesis Global Capital and crypto exchange Gemini with offering unregistered securities through Gemini's Earn program. In December 2020, Genesis, which is a subsidiary of Digital Currency Group, entered into a deal with Gemini to offer the exchange's customers the yield-earning crypto product, which was then launched in February of 2021. Under the agreement, Gemini customers could loan their crypto to Genesis under the promise that Genesis would repay the loan with interest. Genesis had full control over how they would earn a yield to repay Gemini creditors. According to the SEC, Genesis loaned Gemini users crypto and sent a portion of the profits back to Gemini, which they then deducted an agent fee, sometimes over 4%. Then the remaining profit would be sent to users. SEC officials said Genesis should have registered that product as a securities offering. The chair of the SEC, Gary Gensler, said in a statement, "We allege that Genesis and Gemini offered unregistered securities to the public, bypassing disclosure requirements designed to protect investors." Gensler added the charges build on previous actions to make clear to the marketplace and the investing public that crypto lending platforms and other intermediaries need to comply with our time-tested security laws. The SEC says the Earn program netted the companies billions of dollars in crypto assets. The agency is seeking civil penalties against both Genesis and Gemini, and they noted that investigations into other securities law violations and into other entities relating to the alleged misconduct are ongoing. Tyler Winklvoss, the co-founder of Gemini, fired back at the regulator, charging the exchange over issuing unregistered securities, calling the allegations super lame and a manufactured parking ticket. In a series of tweets, Tyler Winklvoss writes, "It's disappointing that the SEC chose to file an action today as Gemini and other creditors are working hard together to recover funds. This action does nothing to further our efforts and help Earn users get their assets back. Their behavior is totally counterproductive." As a matter of background, the Earn program was regulated by the New York Department of Financial Services, and we've been in discussion with the SEC about the Earn program for more than 17 months. They never raised the prospect of any enforcement action until after Genesis paused withdrawals on November 16th. Despite the ongoing conversations, the SEC chose to announce their lawsuit to the press before notifying us. Super lame. It's unfortunate that they're optimizing for political points instead of helping us advance the cause of 340,000 Earn users and other creditors. We look forward to defending ourselves against this manufactured parking ticket, and we'll make sure this doesn't distract us from the important recovery work we are doing. And at the same time, the Digital Currency Group might have to sell assets from its venture portfolio to come up with funds to help Genesis to cover a $3 billion shortfall. That means DCG's stake in more than 200 crypto projects, including data firm Dune Analytics, Ethereum blockchain explorer Etherscan, crypto exchange Coinbase, and USD coin issuer Circle, could soon be up for sale. After a heated community debate last month, Polygon Labs appears to be moving forward with its plans to hard fork the network early next week. Polygon Labs claims the hard fork, which is proposed to occur on January 17th, will help prevent the network gas fee spikes and address on-chain reorganizations, also known as reorgs. Unlike soft forks, hard forks are not backwards compatible and require all node operators on the network to upgrade to the latest software at a specific time. Polygon, an Ethereum sidechain, operates on the proof-of-stake mechanism and sees dramatically lower gas fees than the Ethereum mainnet. However, it's not immune to traffic spikes that can slow the network. The reduction in gas fee spikes will be achieved by doubling the value of the base fee change denominator, which Polygon says will help smooth out the increase rate in base fee for when the gas exceeds or falls below the target gas limits in a block. For the reorgs, the developers want to reduce the amount of time it takes to finalize a block to verify transactions successfully. The goal is to reduce Polygon's sprint length to 16 blocks from 64 blocks, allowing validator nodes to better reconcile what the correct chain is, as more blocks will be produced in a shorter period of time. Even though the FTX bankruptcy was 2 months ago, the issue is far from over for the crypto industry. Currently, FTX CEO John Ray and his team are working to find as many liquid assets as possible to make up for customer losses. As we reported yesterday, they've managed to recover around $5 billion in liquid assets. An attorney at FTX said they plan to dump non-strategic holdings with a book value of $4.6 billion, which could lead to a tremendous selling pressure in the crypto market. They also stressed that the legal team is still working to create accurate internal records, which could mean that the sale will be pushed back a bit, and the liquidators could also take a staggered approach to the process. The largest position is Solana, of which FTX owns more than 700 million. However, most of them are locked, so we're not sure why they might have counted those. This is then followed by 575 million in FTT, 371 million in Maps, 127 million in Oxygen, 90 million in Wrap Bitcoin, 82 million in Bona, and around 500 million in other random Solana-based tokens. However, the $5 billion figure is far too high for what could be sold on the open market, so who's to say what they will actually end up with. Former FTX CEO Sam Bankman-Fried Bankman-Fried posted a pre-mortem overview of the collapse of FTX yesterday as a letter on Substack. Sam Bankman-Fried denied allegations made against him in the lengthy letter and maintained that FTX US had been fully solvent at the time the firm filed for Chapter 11 bankruptcy, with approximately $350 million in cash available. Bankman-Fried further stated that FTX International had a substantial amount of assets, approximately $8 billion, when John J. Ray became the CEO. According to Sam Bankman-Fried, no funds were stolen. Alameda lost money due to a market crash it was not adequately hedged for, as have Three Arrows Capital and others this year. The team behind the Cardano ecosystem will release a software toolkit later this month that will enable developers to deploy custom-built sidechains on Cardano aimed at improving the ecosystem. The news was announced on January 12th by Input Output Global, IOG, a blockchain engineering company founded by Charles Hoskinson and formerly known as Input Output Hong Kong. IOG developers have already used the toolkit to construct an Ethereum virtual machine compatible sidechain public testnet as a proof of concept. When the audit is complete, anyone will be able to deploy decentralized applications, create smart contracts, and move tokens between different testing chains. The toolkit will also enable creators of sidechains to choose their own consensus mechanism in addition to their application-specific features. The news has Cardano fans pumped, with one member of the community hoping that Cardano experiences a similar price pump similar to that of Ethereum in 2020 and 2021, when many Layer 2 sidechains and utility tokens were rolled out. NEXO has recently been raided by the Bulgarian authorities, and they're currently getting hit with massive withdrawals. Its website lists $2.4 billion in customer liabilities, and Larry Cermak also shared data that he's currently seeing $378 million in total holdings in 19 wallets, out of which $264 million is their own NEXO token, with only $114 million in non-NEXO holdings on all EVM addresses combined. Like CryptoLark says, the best time to get your money out was yesterday, and the second best time is right now. Who knows, maybe they end up being fine, but why take the risk, especially now after we've seen every other crypto lender go under. Hector is an expansive DeFi ecosystem that runs on the utility token HEC and the Tor stablecoin. The project aims to push the Web3 agenda by offering decentralized products, including an NFT marketplace, collections, and tokens like a stablecoin. Our partners at the Hector Network have had a great year in 2022, which we've written an article about on our website. I'll put the link to that down in the recommended reading down below. In June, Hector took huge steps towards cross-chain expansion. Hector became available on the BNB chain, and both HEC and Tor were added to ApeSwap. Then in July, Hector Network expanded its presence on Phantom and the BNB chain. First, Hector's farms and pools became available on ApeSwap. Secondly, HEC and Tor were listed on PancakeSwap. These were crucial upgrades for the network. And one of the core offerings to expect in Q1 2023 is the launch of the Atlantic NFT marketplace. NFTs are a big part of Hector's vision, and this marketplace will give both NFT users and creators an unprecedented chance to relate with NFTs. Ethereum has reached another milestone as the number of validators on its network now exceeds 500,000. Validators are essential in guaranteeing the integrity and security of the Ethereum network. They operate by consensus to process transactions on the blockchain by verifying that the conditions specified in each transaction's smart contract code have been met. A validator must deposit 32 ETH, roughly $45,000, to run a dedicated staking node on the proof-of-stake blockchain. The increase in number of active validators is a positive sign for the Ethereum ecosystem, and it wouldn't be surprising to see even more people spin up validators after Shanghai, as they gain the peace of mind knowing they can unstake their ETH more fluidly. That's it for your Altcoin Buzz news update. I'm your host, Cody Buffington. Thanks for watching.